Okay, perfect. We're in business. All right, let's go. Now this is going to be fast presentation. So, okay, markets don't work when markets are highly emotional. Check this out. 1925 to 1929. Pretty cool event happened right after that, which is a horrible event, not cool, but highly emotional, highly volatile. How about the stock market crash, right? So what happened in the 1929 crash, right? The market traded up to, let's go right here, from 1925 at a low of 115 in the Dow up to 386. Then what happened? The market crashed. I mean, just absolute devastation. And the market sold down to 219 in the Dow, right? We bounce up and then back. And then eventually, after a hard-fought battle, the market gives it up. What was that level, right? That was the 61% retracement of the move prior to the crash. So, do you think back in 1929 people were following the fib retracements back then? I don't think so. I think there's actually something to this level, this magical level here that held, the first real collapse that we've seen in the American economy. Okay, so kind of something what we're going to talk about here today. There's a lot more to this. We're going to put an actionable trading plan behind it. I have some cool animations in the charts, as you can tell, which is why I needed the presenter mode to work here. So we'll get into that. Just a little bit about me, guys. So I'm Todd Gordon. I run tradinganalysis.com, and I've known Fausto and the team in the industry really all I've done out of college. I've done quite a bit with CNBC, and I've been lucky enough to meet some pretty fun, pretty talented people throughout the year. So it's been a great run in the industry, and I love what I'm doing, and had some pretty fun people in crossing paths. That's Donald Trump. He was at my wedding, and then Damon from Shark Tank. He was pretty cool, and this is my personal favorite, Cliff Clavin from Cheers. You recognize him down there? So it's been pretty fun. So I live here in New Jersey. I'm from way upstate New York. Married. I have twin boys, Jake and Brody. So they're a year and a half old now, and driving us insane. I love them. And I've done a lot with CNBC. You guys may have seen me on, and over the last 5-6 years, I've probably been on 200-300 times, and they go to me as the technical analyst on CNBC. I've been on the Fast Money desk, and now that this works, here's one of my favorites. I actually dropped the microphone live on TV, and Mandy Drew was laughing at me. Yeah, there it is. Yeah, they're laughing at me. So it shows you just, obviously I'm not much of a presenter, as you guys can tell already, but I do love the markets, and I've been in and around it in a while. So so that's a little bit about me. So enough. Let's go, guys. I want to talk about you. Do you have any of these presumptions? Okay, we already talked about this. When technicals don't work when markets are highly emotional, we're going to dive more into that. Technicals are self-fulfilling prophecies. Do you believe they work only because everyone's watching that level? Do you believe that you only need to trade when there's a clear buy-sell signal? I think I'm going to try to work against each of these presumptions if you, in fact, carry them. So let's keep going. 1929, we bounced up to the level post-crash. This happens to be the 38% price retracement of this decline. We sold off, rallied up, hung out again, then topped out at the first kind of counter-trend reaction to the 1929 crash at 291. It's so weird to say Dow, 291. So that's a 50% price retracement, and then we sold off. So basically, the 1929 crash, we held the 618 retracement I showed you before, went up to the 30%, went to the 50%, and then sold off. And again, do you think traders in the 1920s were watching Fibonacci retracements? I don't think so. I don't think at all. I think there's actually something to it. And I'll go to show you that in fact, I think technicals and specifically Fib works better in highly emotional markets. Okay, it's the quiet markets, low volatility. That's where you got to watch for wandering markets. Okay, so let's keep going. 1932 low. We rally up, sell back down again. More selling in the late 30s, early 40s. Where do we stop? 618 retracement. Rally up, back down, retest the 618 retracement, do a nice double bottom, and then we're off to the races. Okay, so Does it only work in the 29 crash? Nope. How about 1987? You do 2 fib retracements from this swing low and this swing low up to the high, and we held the 38 and 50% price retracements, and then 87 crash over. So again, I hope you're thinking this. Todd, how do you know where to start and stop the fib ratios, right? If you're thinking that, I totally hear you, and I'm going to answer that question for you very specifically. Okay. So from there, let's take a look at the modern day, right? 2002 crash. WorldCom, Enron, Greenspan slashing interest rates, 50%, 618 price retrace. WorldCom, Enron, Greenspan slashing interest rates, 50%, 618 price retracement. That was the general area that we held, and we're off to the races again in the housing rally, right? So, am I cherry picking, this stuff? Does it only work on super long-term levels? No, I'm a swing trader. I like to swing trade stocks. I do a lot of options trading. I'll hold positions for like a day or two if they're horrible positions and I need to stop myself out. Or if they're good trades, maybe 3, 4, 5 days. But you can day trade this stuff. You can move in and out, hour by hour, day by day. You can use this style of analysis on any time frame. So the analogy I like to use with fib is like when you plan a trip. And those of you who've been to Vegas, you know how this goes. Like the Bellagio is right here. So your wife's like, all right, I want to go shopping at, how about the Encore? That's awesome. And you're like, okay. So I look at the map and we got to walk down Vegas Boulevard. And of course you got to go over the stairs, cross over by the Casino Royale. I don't even know what that is. Over this, that. You're like, okay, well, it looks like to be what? 1, 2, 3, 4 blocks. 4 blocks in New York City takes you what? 15 minutes to walk, 20 minutes to walk 4 blocks. Well, what you're missing is this guy down here, which is the scale. In Vegas, the scale is very important because you don't realize how big Vegas is. This walk could take you like half a day, right? So fib is the same thing in that it helps you plan how long your trip or your trade is going to last. Gives you a starting point and a stopping point. And that's very important from a trading point of view, is to have a plan as to when you expect to get in and when you expect to get out, and what your profit targets are, your entries as well as your stop losses. All can be derived from fib, okay? So that's that. Kale, yes, I use fib timing, but definitely I'm not going to have enough time in this presentation. But fib timing for options, we do it all the time to pick out expirations and stuff. So absolutely. But again, no, I could cover everything in an hour, especially with me fumbling around PowerPoint earlier. Okay. So myth busting number 2, technicals are self-fulfilling prophecies. And the gentleman here, John Murphy, who I think is kind of the modern day kind of grandfather, Don Corleone of technical analysis. He was the CNBC's technical analyst in the 80s and 90s, even before it was CNBC. And I've been doing it since 2008. But he just puts it beautifully. And I'm just going to quote him here. He says, self-fulfilling prophecy is generally listed as a criticism of technical analysis. It's more appropriate to label it as a compliment. After all, any technique that becomes so popular that begins to influence the outcome of events would have to be pretty darn good. We can only speculate as to why the concern is seldom raised regarding the use of fundamental analysis. So basically saying, okay, if it's a self-fulfilling prophecy, fine, it actually begins to influence the outcome of markets, then we must pay attention to it. It doesn't really answer the question, is it a self-fulfilling prophecy? And I think the answer is a combination. To a certain extent, yes, major traders are watching the key technical levels, but as we showed you in the 1929 crash into the 30s and 40s, people aren't just trading at these levels. They are actually uncovering a structure or a rhythm or patterns in the market that, with a trained eye, you can see. Okay, so number 3, I only trade when my indicator issues a clear buy-sell signal. Guys, I wish trading was mechanical, and I just don't think it is. And I think many of you would agree. It's not just science and math. There's a third element, which is psychology. And that's what's so cool about trading, right? It's art, it's science, it's math, it's psychology. All these cool subjects, I think, are all wrapped up into one, and that's what a trade is. You have to train your eye and look for patterns and structures. You have to put an element of science and math in it, as well as psychology. And what's important, and this is kind of a tangent, but it's not just the market psychology that you need to understand to trade it. It's your own psychology. And that's, something for another time. But I mean, that's why I love trading. It's all of these things wrapped into one. Imagine a class in college that covered that. That'd be great. So, I think, when we all started trading, probably had a bunch of indicators, and we used one for like 2 weeks, and then we changed it, and then you went to another indicator, and you're like, why is this, why am I not having any success? Why am I losing money trading? Right? I think you've got to do something different than other people. You've got to be a step ahead of the crowd. You can't just be reacting to the same indicators that everyone else is reacting to, right? So, and this is one of the reasons I really needed to get the presentation working, because look at this. What's causing this Dow Jones Industrial Average chart to move? Okay, price. What's causing stochastics and MACD to move? Price. So if you're going to trade off MACD and stochastics, you're reacting to Stokes and MACD, which are reacting to price change. So like what you're saying is you're like using 3 different levels ahead. You're reacting to indicators which are reacting to price change, and everyone else is using it. Like, how can you make any money with that, right? So I think we need to get ahead of the market a little bit and start to anticipate things, right? So is it perfect, my style of trading? No, guys. I'm a trader. Fausto's a trader. I mean, we're going to have down days, down weeks, down months, okay? We are going to try to get into a trade, and we're going to risk like 2 to 1 is not – if you guys ever really kept your stats, it's really hard to get to 2 to 1. I mean, I'm like 1.48 to 1 on average over the years. They don't call it kind of killing. They call it hunting, right? They don't call fishing catching, right? We're not sharpshooting, guys. I'm going to give you a small edge that will get you ahead of the other traders in the market, that will give you that leg up, okay? This is not the end-all be-all. I wish I had it, but I kind of think it doesn't exist. And you guys are educated and smart enough in this business to know you're just looking for that one little tool that'll give you an edge ahead of your fellow traders. Okay, so let's take a look at this. Okay, no. We'll play a little movie here. This is an actual trade we did with clients, anticipating support in that fib support zone, 25, 30, 24.80. As soon as we enter the zone, we put the trade on. This was an actual trade we put on. Not all the trades work this well, but when they do work well, we have a small stop, small target zone, and we'll get our profit target, okay? The next one, this was a McDonald's trade we had. This was a short into fib resistance, $97 to 99. We're short right in the zone, and this was an actual trade. I did a 95.90 put debit spread in McDonald's. It went right down to our short strike, and boom, we're out of the trade, right? So it's anticipating trades before they go on. Guys, I have a rule, like I don't like to put a trade on unless I knew I was going to do it 3 hours ahead of time. I'm a swing trader, right? Like I like to hold positions for a day, 2 days, maybe a week if it's a good trade. I play golf. I live in a golf course here. I'll put trades on, and then I'll go play 9 holes, come back. I'll check it on my phone. I mean, that's my style. Fausto's got way too much energy for me, to be in there really rolling up the sleeves, day trading it and scalping it. That's a tough guy's sport. I'm a little wimpier. I like to swing trade and hold positions and not work so much. Yes, you absolutely can use this fib on day trading. So I'm messing with Fausto. I've known him for like 10 years. He's a buddy. I got a ton of respect for him. So yes, day trading, yes, but only do liquid stuff. You don't be doing it on 100,000 share or less, day stocks. You got to be trading the big, thick liquid stuff. But yes, you can. Okay. So, God does not play dice with the universe. Albert Einstein. Okay. He actually says there is pattern and structure to all of it, right? So this fib stuff we're talking about, I'm not going to get all crazy. I'm not going to like start burning candles down in my office here and do seances and stuff. But it does help us to understand seemingly random occurrences, social progress. If you think about this, this is pretty cool. Society's report card is, in fact, the stock market. The higher our stock prices are, the better we as a society are doing. We're fighting with each other less. There's employment, the inflation's somewhat under control. Energy prices are under control. We all are getting along and doing well. So social progress is not random. We are actually patterned, and humans tend to have the same repeatable tendencies and mistakes, and we all like to fight with each other over stupid stuff, and that tends to be the low points in equity prices. And when we're all getting along and doing well, our equity markets tend to do well. So neither of these things, social progress or markets, are random. They are in fact patterned, and we can uncover some of those patterns. Okay, I know it's crazy. I can't believe I'm saying these words. But trust me, it works enough that I do it every single day. So it's pretty fun. And plus, just do a Google search on Fibonacci, and you'll waste a half a day. So here's the fib. This is the fib progression. You guys ever watched the Da Vinci Code? I mean, this is like the Da Vinci Code of the stock markets. So Robert Langdon does a great job explaining fib. So just know that a lot of it is based on the 61% retracement. And then from there, we have a whole bunch of calculations off of that. And I'll show you the most important ones. Here are the fib ratios we're going to use. And don't worry, we'll make this presentation available so you don't have to write them down. But for this presentation, we're really going to be using these two guys, 786 and 1272. These are very powerful for entries and exits, okay, and also for kind of boundaries or lines in the sand, so to speak. So it's all based on 618, but 786 and 1272 you're going to see quite a bit in this presentation, okay? All right. Okay, so here we go. First, how do you start making money with this stuff, right? So you want to identify swing waves. Okay, this is going to help you understand where to start and stop your fib. So a swing wave is a low or high in a chart where price reverses trend. Okay, so a swing wave high is the current high has a lower high before and after the bar. A swing wave low, the current low has a lower bar before and a lower after. Okay, so what does all that mean? Here's what it looks like. A swing wave high is a high bar, get my laser pointer, is a high bar with a lower high left and a lower high right. That's all a swing wave is. This is what Apple, okay? You have a swing wave high here with a lower high left, a lower high right, swing wave high here with a lower bar left, lower bar right, swing wave high here, lower left, lower right. I missed this one because this is a swing. You got lower high right, lower high left, swing, lower high left, lower high right. Very simple, right? You guys got that. Swing wave low, same thing. It's a low bar with a higher bar left and a higher bar right. And what I'm saying is the low is higher than this bar. The low is higher. The prior low is higher. Okay, so that's a swing wave. Okay, real simple. Same chart with Apple. Here, your swing wave lows labeled. You know, low bar with a higher one left, higher one right. Low bar with a higher left, higher right, so on and so forth. Okay, I did miss that one right there. There's a swing with a lower high left, lower high right. Don't worry, I have an indicator for you to pick these out. But this is the basis of where we're going to start using the fib. Okay, so this is swing wave low, swing wave high, all labeled. And Stephen, yes, you can use this in candlesticks. I just like using bars rather than candlesticks. For me, but yes, everything I'm talking about you can use on candlesticks. Okay, so now here's where we start getting into the meat. Okay, major and minor swing waves. All right, a minor swing wave is a swing wave that we just talked about that is exceeded in the 5 bars before and the 5 bars following. A major swing is one that is not exceeded in the 5 bars following and the 5 bars prior. Okay, so what does that mean? A major swing wave is basically this. If you have a swing wave high that is not exceeded in the 5 bars prior and the 5 bars following, you have a major swing. This is where we're going to start building our fib. This is how you know unquestionably where to start and stop your fib. This is really, really valuable, I think. Okay, here's a minor swing. You got a swing wave high here. Pardon me, sorry. I'm drinking coffee too fast. You got a swing wave high here with a 5 bars lower to the left, so that's fine. But then start counting 5 to the right. 1, 2, oops, wave 3 breaks above the high of this bar. So now we know that it's a swing, but it's a minor swing. It's not a major. Okay. Yep, Ollie, no problem. So we just broke out above. Now, of course, you're not going to know their major and minor swings until after the fact. Is that useless for calculating fib on your next entry? Absolutely not. And I'll show you as we get through the presentation. Okay, so this is Apple again, and I've labeled all the majors and minors for you. Okay, so you get a blue is your major, so you count 5 bars left, 5 bars right, no problem. Here's a swing here. If you count 5 left, obviously this one made a new high, right? So this is not a major swing, but a minor. Here's a major, here's a minor, 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 major. You just got to kind of use your eye trained to looking for those. But again, I have an indicator already built, so it's cool. Okay, so put that in your pocket right now. And now we're going to shift over to calculating trend. So you know swing waves now. You know majors, you know minors. How do you determine the trend of the market? Real simple, just the 55 EMA, right? The 55 period exponential moving average, in my opinion, is the best representation of what the trend of the market is. And, you know, somebody say, well, could you use a 34 or 30 or a 20? Yeah, whatever. You know, I think anything less than 50 is too sensitive. Anything greater than 100 period moving average is too slow. So for me, I think 55 is the best representation. And why 55 and not 50? 55 is a fib number. Okay. NTZ, there's actually not latency, because I'll show you. I know what you're asking, but you will see it coming up here. Okay. So you want to be able to go back in time and count, because that's where you're going to start and stop your fib retracements and fib extensions and projections. That's going to help you enter the next trade. Don't worry, I'll take you through it. Okay, so 55 EMA is the trend of the market. Real simple. Now, those of you who are a little bit more experienced, who can pick up the trend of the market, just, you know, if the chart starts in the bottom left and heads to the top right, I think you have an uptrend. It starts in the top left, going to the bottom right, I think you have a downtrend. But if you want to use this as kind of like an aid, 55 EMA is the trend. Okay. For this trade setup, I'm going to teach you guys right here. We only want to be trend trading. Okay. I do counter trend trade. I do fade market rallies, and I do buy market bottoms, but only when all 3 fib tools come together. But for this strategy, we are trend trading. Okay. So the 3 tools, 3 main tools are retracements, external retracements, and projections. We are going to concentrate on retracements, and we're going to just touch on external retracements, or what you can also call extensions. Okay, so those are your 2. John, yes, any time frame you want to trade. You can use this setup. Let me say this again, guys. You can use this setup any time frame you want, as long as it's a liquid stock down on that 1 minute, 5 minute stuff. If you want to do this on daily, weekly, no problem. You can trade this setup in any time frame. Okay, so retracements, perfect. Now, primary goal of trading can be summed up as the following. Trading, in my opinion, 80% of trading is this. You simply want to buy weakness in rising markets and sell strength in falling markets. That's all you need to do as a trader. All these fancy tools that we're talking about here are designed to do just that, which is to get you in at the end of the weakness part, or the correction within a uptrending market. Or you want to find the end of a rally within a longer-term downtrend to be short. That's all trading is. So fib retracements help us to do just that. Rising and falling markets are determined by the slope of the 55 EMA, right? So all we want to do is find a trending market, use a fib retracement to get us in as close to the end of a pullback before that longer-term trend resumes. Okay, so this is just a general look at what a retracement is. Okay, we have a stock that goes from $200 to $300, 55 EMAs up. We are going to unfold in a correction looking for the end of the correction into one of your retracements. If the stock goes from $200 to $300, $100 rally, a 38% pullback is a $38 sell-off. A 50% pullback is a $50 sell-off. 618 is a $61 pullback, 61.8%. Pretty simple, right? So that's what a basic move Pretty simple, right? So that's what a basic move retracement looks like. So now let's dive in. The easiest way for me to introduce this trade setup for you is to just do it live in a trade here. Okay, so Apple is on a 3-hour. Okay, and again, doesn't matter the time frame, JD. Doesn't matter. You can do this. I'll say this again, guys. You can do this on 1 minute, 5 minute, 15, 30, 60. Doesn't matter. Any chart you want. Anything, I promise. So Apple 3-hour. Okay, we have 55 EMA starting to move up. We are in an uptrend in Apple. Surprise, surprise. This was obviously pre-split. Isolate the trend, number 1. Number 2, wait for the trend to exhaust itself and begin to pull back. Starting to get a pullback, and you can see that EMA flatten out a bit, go sideways. That's okay. You know, you can see a little reaction, a little kind of sideways. I mean, obviously EMA is moving up, and then you go sideways. It's taking a break. That's what you want. From here, you want to identify the most recent major swing wave high. You want to see the market begin to pull back. Then you're going to go back and identify the most recent major swing wave high. Remember, major swing wave high is the high has not been exceeded in the 5 bars prior or the 5 bars following. Okay, so back to your point, Eric, people focus, please. You guys are funny. Okay, so I forgot who asked me. NTZ, you said, is this kind of a look back? I forgot the term you used, which was a good one. Is it not useful because you're looking back in time? No, it's not, and that's how it actually needs to be. Okay, so look for the most recent major swing high, then find the most recent major swing wave low. Okay, so you got high, low. This, okay, this is the starting and stopping point, or what I kind of call the anchor and the flagpole of your fib retracements. This is where you start because this is the meat of the trend. You have a major swing high here in blue, major swing wave low there in blue. So that's the trend you want to study. Okay, go back. Okay, so repeat. And number 2, use your fib tool. And these Fibonacci tools come on almost every charting package out there. I mean, anything you guys use, guarantee you'll have fib. And you also have extensions and projections, which are cool. So like 90%, doesn't matter if you're on TradeStation, TOS, eSignal, you know, whatever. You want to click the beginning of your trend first, then the end of your trend, and then your retracements will unfold. So generally, you want to click the beginning of your trend first, then click the end of your trend, and then the retracements will unfold. Monitor the pullback, looking for swing waves against your retracement levels. These serve as entries. And again, I hope you're thinking to yourself, Todd, what the hell good is this? Because I have like 6 of them. How do I know where to enter? Are you thinking that? I hope you are. Okay. Here's how you're going to look for entries. Entries occur after a 3-wave swing. You want to have a swing wave low, and it could be major, minor, doesn't matter. You want to have a swing wave low, a swing wave high to a lower high. You don't want to break to a new high. You want to have a failed rally here, then down to a new low. So you want low, lower high, lower low. A 3-wave swing will ideally terminate between your 38% and your 61% retracement of that swing that we identified. Let me go back from major swing wave low to major swing wave high. And you will allow for down to the 78.6% retracement. Okay, so, and I haven't given you the entry yet, okay? Don't worry, I haven't given you the actual how to get in yet, but I will. Let's go through this example again, but we'll do it with crude upside down, crude oil downtrend, clearly 55 EMAs down, isolate the trend, wait for the trend to exhaust itself, begin to pull back. You know, look, the EMA is starting to flatten out a little bit as prices did make a new low here. That's fine. The downtrend is still in place. Identify the most recent major swing wave low, which is going to be the low bar here is going to be your major swing wave low. That's the one constant here. You want to find the most recent major swing high, and it happens to be right here. Use your fib tool. You want to click the retracement tool, click this in a short, it's the swing wave high first, then the swing wave low, then your retracement levels will unfold. Monitor the pullback, looking for swing waves against your retracement levels. These serve as entries. So you're looking for a reaction back up. Okay. Now, for shorts, remember, you need a 3-wave swing. You need a move higher, and you got to have a swing wave. Got to have a push lower. In the case of a short, you want to make a higher low. You don't want to go to a new low. Then you want to have a higher high. Okay. You're then looking for it to be between the 38 and the 61%, and you can allow for the 786 only in certain situations. There are certain times where I look for 786, but generally you want to look between 38% and 61% after a swing high to a higher low to then a higher high. So an A, B, C swing, you are now looking for entries. Entries occur after 3 swing waves. Okay, 1, 2, 3. Now, how do you enter this thing? Okay, here's where I start to pull it together for you. All right, we learned what swing waves are. We learned how to determine the trend in the market. We've learned what a Fibonacci retracement is. We learned the pattern we're looking to trade. Now, here's how you actually trade it. Okay, Lee and James, I'm going to answer those questions after. I want to make sure I get my time in here, but good questions, and I'm going to answer those. Okay, so money management. It's not how much money you make, it's how much you keep, right? We're going to show you how to handle all aspects of a trade. This trade setup you're going to be able to trade on Monday. Okay, entry, stop placement, how to take profits, and stop trail plan. Here's the complete trade plan. I'm not going to read this. I'm going to take you through it step by step. Okay, so this is gold on a 4-hour chart. Again, doesn't matter what time frame you're on. This could be a 5-minute chart. After a clear 3 swing wave, okay, gold is up. I don't have the EMA on here. I left it out, but I think you guys can tell the trend is up. We go up, and gold started down here before. So the moving average is clearly up, so you're looking for longs only. You get a swing wave low. You get a swing wave high to a lower high, and then down to a lower low. Now, you are going to look for entries once you move above the high of the last swing wave low. Okay, so this is the final swing wave low. Okay, you're down. Here's your low bar. Okay, do you know that's going to be absolutely the low? Without question, no, you don't know, because I wish I had a system to tell you, here's the end of the correction, bye. You know, that's it. We're definitely going higher for here. Okay, as soon as you start making a new low here below the first swing wave low, you are on guard for an entry. The entry occurs after you take out the high of your last swing wave low. So your entry is up here. So here's your low bar. I just kind of zoomed in, right? So this bar right here is this bar. Once you take out the high, you're in. You're going to buy stop in 1 tick above the high of this bar. This was a double top, sold off, came back, then we were triggered right here. Okay, that's your entry. Long above, enter long on a move above the low bar, which is your final swing wave low. Place a stop a few ticks, pips, cents below the low of that bar. So your entry is a move above the high of your swing wave low, and the stop is below the swing wave low. Okay, so that's fine. If you're stopped, if it goes down here, makes a new swing wave low, you can take the trade one more time. I'll take it up to twice. Okay, this is not a great example because I'm down to the 786 retracement. Those of you who use Fib might have noticed that. I probably would not take this again. If this action happened at the 618 or the 50%, I will take this trade again. Okay, but being that we're so far down into the 786, not a great example. I should probably give you a better example. But if the swing wave happened down there, you're above 618, then you could take this trade again. So now we got in the entries. We know how to enter the trade. We know where to put a stop. How do you take profits? Okay. Fibonacci extensions. Okay. Let's see. Seems so complicated. Not really. How much time you spare for analyzing the market? I think, if you're working part-time, I mean, you're working full-time or trading part-time, you should be able to do all the analysis in half hour, 45 minutes. This stuff becomes much easier. Ollie, isn't that a 2K stop? I mean, most of the time I trade GLD. You know, if I'm swing trading on a 3-hour chart, I mean, most people, and I get this question every time, Ollie, if you're trading futures on a 3-hour chart, you better have like a $250,000 account, right? You can take this trade setup and go to a 5-minute chart, and you can trade futures, right? But if you're trading a 4-hour time frame, you probably, and you don't have a $250,000 account, probably should be, you know, trading GLD, do the ETF, you know, keep it under control. Okay, so now how do you take profits? Fib extensions. Here's our next fib tool. Retracements are used to measure how far a 3-wave corrective swing will last before the predominant trend resumes. Extensions are used to measure the 3-wave corrective swing to project how far the next wave will be. In English, it's a retracement that travels more than 100%. I'm sure you're confused right there. No problem. Let me show you on the chart. So here's how you calculate an extension. Okay. Identify the market trend via the 55 EMA. This is the NASDAQ on a 3-hour uptrending. I love the 3-hour chart, by the way. I think it's a great swing trading chart in today's volatility environment. Isolate a 3-wave corrective swing. You get a major swing low there. You get a major swing wave high there to a lower high. Then you get down, gap down to a lower low. You have a 3-wave swing against the uptrending market. To calculate Fibonacci extensions, these are going to serve as your take profits or your targets. You're going to use your retracement tool. It's a retracement that goes more than 100%. If you were to just measure a retracement for this correction, you would click first here, you'd click there. So you click here first, here next, and then you'd see the 38%, the 50%, the 61%, the 78.6, and then once you're up to 100%, 100% is right there. Once you get above here, you go from retracement territory. Oh, come on. Oh my goodness. Let's go. Hold on. We're on slideshow. Let me get back in. Boy, that was anticlimactic. I won't use that tool again. All right, here we go again. It's a retracement that goes beyond the 100%, right? So from here to here, once you go past 100%, you're then up into your extension territory. And here's where you will look to take profits, right? So it's just a retracement that goes 100% right there. And then you go up to the 1272. That is your first extension. And then the 1618. Those are where you're going to look to take profits on your long setup. So how do you do that? Extensions will unfold above the start of your 3-wave correction. So once you go past the high, you're into retracement territory, then you go into extension territory. Okay, so here's how you actually look to book profits on the trade. This is your gold setup. I'll get my laser pointer. You're going down for your swing wave low, back up to a lower high. Your long is above once you take out the low of your final swing wave low. Or sorry, once you take out the high of your swing wave low, your long. Stop goes below the low. You're going to look to book half profits at the 786 retracement. This is kind of a secret. A lot of people don't know about. The 618 retracement is an example of a retracement that a lot of people watch, and it'd be right about there. And a lot of times you do get funds and hedge funds and market makers trying to push through that level to run stops. By the time, you know, the 618 stop run is over, it usually gets up to the 786. 786 tends to catch a lot of deep retracement levels and then move down. So if you're going to have a false break in this move, you want to be booking partial profits at 786 because that guy reverses quite a lot of trends. So you want to look to take a half or maybe a third, either one, half to a third of your profits at the 786 retracement. Let me erase all link. There we go. You're then going to trail stop the entry price or the more recent swing low, whichever's higher. So you have a swing wave low, and get my laser pointer. You have a swing wave low right there. This is the most recent. You took profits here, so your entry is actually right on top. Your entry is right here. The most recent swing low is there, so your stop is trailed up to this point. And again, I have an indicator for you that tells you exactly where the swings are, so it's pretty easy to recognize as the trade is happening. So you've booked half profits at the 786. Stop goes to your entry or the most recent swing low. You're then looking to get up to the 1272 to book a majority of your profits. Guys, if this was a $10 drop in gold, a $10 rally puts you at 100%, and then the 1272, which is a $12.70 move, that is a Fibonacci level that is based on the 786. It's related to the main Fibonacci number 618. So I won't go into the math, but those two play very well together. A move that breaks 786 more times than not will go up to the 1272 and then hang out. You want to be booking majority of profits up there. Okay, so if you think about all this work, and I understand it's a little bit more complicated than used to. I got it, but how many times have you guys been in the situation? Crude oil dropping down. God, it looks like it's going to break through the $45 level, and you get short. There's so much momentum behind it, and you're like, okay, this is gonna break to new lows, and then it goes back against you, and then you're like, oh my God, I did it again. I chased the low. Then it goes back. Oh God, I'm back at break even. It's gonna go this time, and then it goes back up. And you're like, oh my God, it's $1 against me if you're trading USO or futures. It's painful. And then you go and you finally kind of close the trade out of break even. So you took a lot of stress because you kind of chased down to the low. Who has done that trade? I'm not even going to ask ever because we've all done it, but who's done it recently? I want to know because it is something that just is so painful to chase breakdowns and breakouts. If you just wait, okay, wait for your 3-wave correction, okay, into one of your fib, 38 to 618 zone, use that 3-step process, swing wave high, swing wave low to a higher low, swing wave high to a higher high. Your entry is a move below the low of your high bar. Stop goes up there. If you're short up here, it's a much different experience and feeling than being short down there. This is reacting to the market. This is anticipating. And when you deal from a position of strength by showing patience in doing this work that I'm asking you to do, to trade from a quality entry point is a much different experience. It gives you so much more options. It keeps your stress lower, and you're dealing from a position of strength, right? If your stress lower, and you're dealing from a position of strength, right? If your entry is down here, you're dealing from a position of weakness, and your emotions are really gonna take a toll on you. That's what I'm trying to get you guys to work towards, is dealing from a position of strength by anticipating the market, not reacting to the market. Okay, so a game plan is what I'm talking about. It's not chasing price. It's not haphazard stops or no stops. Trading by the seat of your pants. I like to use leading indicators. In Fib, I know it's voodoo. I agree. It sounds crazy, but it works. Whether there's so many funds actually watch these levels, or as I showed you back in 1929, it's actually valid. It uncovers rhythms and structures, and it uncovers turning points in the markets that many people aren't paying attention to. It's a game plan. Trading with a game plan it allows you to have a life. I like to go out and do other things, spend time with my kids and play golf. I mean, I love trading, but I come in, do an hour, 2, 3 hours of work in the morning, put my trades, set them up for customers. We go. I set alerts on my phone. I mean, the technology we have now is great, and I know right what to do if that level gets traded. I send a text message alert out to customers, and I think for me, I mean, that's trading with a game plan. That's enjoyable trading. Tony Robbins, love him. Anticipation equals performance. Anticipation is the ultimate power. Losers react, leaders anticipate. And I think that is so true with trading. So you can start anticipating entries right now. I'm going to show you how easy it is to get going. Before, if we have time, I don't know how much time I'm allotted. We can set up some charts. I have some indicators set up for you in TradeStation. I have it in TOS, and I'll show you the swing waves. You know what? Let's do that real quick. So you know what? Let me go through first. Let me just go back and let me keep going, and I'll go back and look at trades after. So I think, guys, if you do it the right way, you can begin finding better entries and exits. Start anticipating. Stop reacting. I think a lot of people kind of overcomplicate fib, put too much fib up on the chart. It's like all over the place. There's like a couple tools you need to use. You don't need to like plaster it all over the chart and make it look like a I don't know. I can't even think of what it means. So guys, I have a course here that if you guys like to continue with me, I'm going to show you how to kind of go to the next level. I showed you a simple trade setup. We can go through some charts. I don't know if I have the time. I'm sure there's another speaker after me. Actually, I know there is, so I'll get going. But I'll show you guys how to set up support and resistance zones, which we call FRZs, FSZs. Stop risking valuable capital on substandard trades. Start anticipating, start paying less commissions by trading less, trade at premium entries, okay? So I have a course. It's done. We just got done 2 weeks ago. It's recorded. It's archived. It's all done. We did about 5 days of live trading. So here's what I'll show you. Here's what I did show you. How to construct fib support and resistance zones. My three favorite proven fib patterns, harmonic patterns. You'll find out what that is. My favorite time frame to trade, I think I already showed you. I love the 3-hour chart because I'm a swing trader, but you can do this on a 5-minute chart if you're a day trader, no problem. Or if you're a position trader, no problem. Okay, so trading rules, time frame, checklist, cheat sheets, entries, exits, stop loss, targets. How to scan the markets for the best fib setups. How to filter the best trades. How to avoid the head fakes. I mean, that's the most important thing. We did actually 4 live sessions. Okay, so they're all recorded. They're archived, no problem. And I know I have to get going here. I'm going to go very quickly. You can take your trading to the next level. Don't chase poor signals. Only take premium setups right now. So it's, guys, for, again, you want to anticipate. It's not the holy grail. I told you this, but it does give you an edge on your fellow traders. If you believe and you're patient and you're disciplined enough to only take quality setups, that's what we're looking for. Not the holy grail, as I said. We don't trade FYE for your entertainment. I'm not going to have you on your yacht from the Mediterranean by March. I guess it'd now be like May, June. And you don't want to make things too complicated. This is not for people who can't make a decision. Be disciplined. This is for people who want to take action. So that's that. If you're not happy, no problem. Money back. I mean, we did a lot of these courses, and I think we had 3 people ask for the money back, and we did a lot. So it was a good course. If you guys want to get it, tradinganalysis.com/now, NOW, and here's what you get. Harmonic patterns, 3 tools of fib. We did art of the trade, account risk and trade management, ART. We did stop trail plan. We did checklist and a cheat sheet. That's done. Profit taking plan. We did 4 live analysis sessions, $7.59. You guys can have it for $97. Okay, so $97 if you guys want it. And you guys are at tradinganalysis.com/NOW. Okay, we are going to only open 25 spots for this recording. So you guys want to move on that pretty fast. $97 and you're good. And we got a lot of good feedback from the course. Okay, and you also get the indicator. Okay, so I showed you the indicator on TradeStation. You get the indicator for free. Okay, it's included. So this is the indicator. We can do some setups. Actually, I'm past my time. I was screwing around with PowerPoint, but you do get the indicator. It's plugged in, and there's actually an update to it. What we've done was I've started to experiment with the major and minor swing waves. So rather than just doing 5, I'm actually stretching them out to get higher quality. I cover that in the course. So I'm doing 13 bars for your majors, 5 bars for your minor. I'm getting better setup. So I cover that in the course, but you get the indicator for free. So that's cool. So tradinganalysis.com/now and $97. The indicator itself, we're gonna charge like $200 to $300. When Hubert and the team get this going, we're going to just kind of offer it to you guys for now, so you guys can have it for $97. Course included, you're good to go. So it's all there. So if you guys have any questions, let me know. Fausto and the team, thanks so much. Sorry for the tech difficulties in the beginning. Novia hates.
All right. Thank you so much, Todd.
Hates it. So,
It was a wonderful presentation. This is
did you see if you guys have
excellent. This is Jesse Colombo, Cyber Trading University's Forex and
My
Futures
pleasure.
instructor.
Thanks.
And next, I'm excited to have John Hutchinson, partner in Traders Reserve. He's actually been involved with the stock markets for over 18 years, and he's been managing investments, studying portfolio models, and teaching technical and fundamental analysis techniques. He's a managing partner at Traders Reserve and also the editor of Main Street Investor and a contributing analyst and writer for Millionaire Blueprint Program. So he's going to be showing us the Millionaire Blueprint Program, which is a powerful yet disciplined investing plan designed to turn your portfolio into $1 million in about 8 years or less. So he's going to be showing hyper compounding investing plan that averages 6.6% returns monthly, even though most investors just scrape by with just 3% per year. And he's going to be showing simple trade triggers so you can automatically secure investment gains and protect yourself from portfolio wrecking losses. So I'm definitely looking forward to having you, John. So thank you so much for coming on.
Thanks, Jesse. Just do a quick audio check and make sure that you can hear my volume.